bugs simply because they have too much money or they want to monopolize knowledge about bugs and so on. So both vendor and user administrated bug auctions are far from optimal and suffer from many problems. So let's go to the next type for vulnerabilities, and these are the vulnerability sharing circles, or how I call them, vulnerability brokers. And just let me sketch the business model behind. You have a vulnerability broker, which is a private company, also a public institution, whatever, and that offers money reward for exploits, or call it vulnerability information, plus a non-disclosure agreement, and thus rewards individual bug hunters. This information is further sold to a closed circle of anonymous, or, well, not rather specified subscribers to a, well, security alert service or to vulnerability sharing circles. And there exist also some real-world examples. There's even some competition which basically drives people to, or these organizations, to offer loyalty programs for frequent reports and so on. And I think you can check or read the websites themselves. For example, eDefense were the first, and now Tipping Point with their zero-day initiative followed suit. And the problem with this type of market is basically that you don't know who actually gains the information. It may be users of software, it may be vendors, but it will also be government agencies. So is this really intended? Is it an agent? Is it a good guy or a bad guy? Or it may be even black hats themselves who join these circles and now get this sensitive information. And you might even call this system like blackmailing the users and the vendors, because you force them to pay a regular subscription to potentially gain some insight in problems in your own products. So let's keep it like this for the second type of vulnerability markets, and go to the third, which is cyber insurance. Cyber insurance, I already sketched it in the introduction or in the first part of the talk, is more or less the fact that you can buy insurance coverage for cyber incidents like privacy violations, security breaches, virus attacks, and so on. And you pay a regular premium to compensate for the risk coverages. Cyber insurance is in general quite desirable because you have benefits on the individual level, so on the firm's level, as well as social benefits. Let's come to the individual benefits. Basically, with risk pooling, I mean that institutions, firms, users can exchange the uncertain cost of future security events to a fixed expense at the present. So it's basically the insurance principle. You insure your car because you have your health insurance, and you feel safer because you can calculate the costs of future states. It is manageable for companies, and because basically they have these fixed expenses instead of the high volatile expenses, they prevent undue shortages of liquidity and thus avoid crisis. And in addition, the premiums are also an accurate indicator of the security, because you have to imagine that insurance companies charge different depending on what security measures you have in place. So, for example, to get cyber insurance coverage, you have to invest into some sound security technology first. This gives you an incentive to invest, and afterwards you get the coverage for the residual risk. And note that this is basically a measure for the value of security features and not for the cost. So the cost of a firewall doesn't tell you how good it protects you. On a social level, we have basically all types of incentives to innovate. Basically, since premiums depend on the level of security of a software product or even a hardware product, the manufacturers may opt to invest more in security, because then they know the premiums for my customers will be cheaper, so the total cost of ownership, and this is a buzzword in different contexts, decreases. So it incentivizes manufacturers to produce security or to produce secure software. Second, incentives to implement not only the production of secure software, or the supply side is supported, but also the demand side. So basically people are buying security technology in order to reduce their premiums, and they are also buying this technology in a reasonable level. That means you don't over-invest in security, but you find the optimal trade-off from an economic point of view. And last not least, because insurance companies have a huge interest in knowing more about the nature of computer security and having all possible types of information, also the research in computer security will be funded, and basically insurance companies may do their own research, may basically increase their information situation to keep competitive. Always assume that we have competition in this market. Now let's go to the fourth market type, which I call exploit derivatives. Here again, like with the cyber insurance, you do not trade the information about vulnerabilities directly, but you rather trade, or you create an exchange platform for abstract contracts. Contracts that depend, or that are derived, that's why we come to the name derivatives, are derived from security events, and a contract could read like this. This contract pays 100 euro to its owner on a specified date if there exists a remote root exploit against a specified software version on a specified platform. Yeah, who would sell or who would buy such a contract? Well, I think I could sell you this type of contract, but not alone, but together in a bundle with the inverse contract. So I sell you both contracts together, bundle the price to 100 euros. So I, as an issuer, do not make any profit, but I don't lose anything either. So both contracts together represent all possible outcomes of future states. So afterwards, the individual participants may opt to use the exchange platform where bids and demands for different contracts are negotiated and prices are quoted to buy and sell one or the other of these contracts. And now let's have a look of who might be the market participants in this case. On the contract that buys, in the bad case, are bug hunters, so basically people that find vulnerabilities after they found one. So then they have more information. They, up to a certain level of certainty, know that there is a vulnerability to be reported before the date of maturity, so they can pay more for the contract than the actual market price, and basically they can extract information, or extract their information, extract money from their information advantage. Also, commercial users of software products may want to buy this type of contract in order to hedge against financial risks that may occur if the bad state actually materializes. And last not least, the insurance companies, which I've already mentioned before, may want to buy this contract in order to distribute risk to more heads. On the other hand, there's also demand for the inverse contract. Bug hunters, if they made a recent code review, for example, and they consider the code as secure, then they have more information than the market, and they, again, can now use this information to buy this, or basically they value the right-hand contract higher than the actual market price, and they can live from the difference. Investors may want a good yield if these contracts really materialize, and if they are used, on the other hand, to hedge the exceptional risks. And last not least, software vendors could use these contracts in two ways. First, if I have a lot of assets in this type of contract, then I underline my security promises that I trust my own software. And I can also use these contracts to compensate my employees, at least part of their salary, in order to give them an incentive to develop secure software, because part of their compensation is regulated by the outcome of the actual security of your product. So let's just have a brief look at a hypothetical chart of this non-existing vulnerability or exploit derivative market. We have the time and days here and the quoted mid price for the contract that pays out if there is a vulnerability reported. And you see that it increases over time, and we have several market points. So for example, if you have rumors about a possible vulnerability, then the market might already react, and because some people might perceive that this software is considered less secure than, for example, other software. And then there is a vulnerability disclosure, but it is not yet clear whether it's exploitable or not. So the market tries to reassess the situation, and it jumps up to almost 90 euros. And finally, you have the last point when the exploit is published, and now it's absolutely sure that one contract will pay and the other not, so the value of this contract is 100 euros. It's also interesting how we can use this information as a measure, or as a measurement, if we have different versions, so if we issue different contracts for different software versions. Look at this. Let's say the blue line is the English version, whereas the red dotted line is a localization. You see that at the beginning, the localization is considered less secure, and we can compute the spread. And the spread between these versions reflects the level of uncertainty, and that comes from the fact that, for example, the localization is not as well examined as the English version or as the standard version, because it is deployed in many more cases and much better better monitoring. And you see then afterwards that the level, the spread remains persistent, and it keeps very, very small on the high level, because if one version is exploitable, then the other one is perhaps exploitable as well, if it is nothing particular to the localization. Of course, there are also, or still, open questions with this type of market, with the exploit derivatives. There are unclear points of how the maturity of these contracts should be aligned, how they roll over between different contracts, between different periods. It is not yet clear, for example, how you should organize the market. Is it a market maker market? Is it a bookkeeping market? Is it, well, do you allow the market participants to participate pseudonymously, anonymously, or do they have to identify themselves at least to a third party? And of course, you need someone who, in the end, tests all exploit proposals and announces the result to tell which contract is actually going to pay. But this is a trusted third party that can be controlled and can be distributed if you require that the party publishes everything he or she receives, and then it is easily monitorable. So after discussing these 4 types of vulnerability markets, we want to have a picture of what are they for, what are the advantages, what are the disadvantages, are there, well, basically risks and opportunities. To better assess the risks and opportunities, I defined, or I stated, 3 possible functions of vulnerability markets and 1 property. And the functions are information function, incentive function, a risk balancing function, and finally efficiency. Let's have a look at the information function first. You know that the quoted market price, and I already outlined this in the previous slides, is a good indicator of the underlying security situation. And this is we have already empirical evidence in the literature that this is the case for existing markets. So there is a number of studies, so-called event studies, that studied or that analyzed the reaction of known common stock markets on announcement of security problems. So there is, for example, the first one was a case study in February 2002, and I think the first 3 always found a negative impact on market capitalization, but only in the very, very short run. And they looked at the impact of the stock price of the affected firm. Whereas the fourth one looked at the impact of the stock price of the manufacturer of the software that has been used by the affected firm. And we see that the